Hello everyone, welcome to the KLI market commentary for the month of March 2023. I am Manoj Bharadwaj and I focus on managing fixed income investments at KLI. As the financial year heads towards a close, I'd like to take you through a quick macro recap of the year gone by and throw some perspective on the opportunities and risks that lay ahead for fixed income investors. The year gone by can be characterized as a year of monetary policy normalization across the globe as the world started moving out of the pangs of the pandemic and into a hostile international conflict which even today threatens to redefine the world order. The year was largely dominated by three factors: geopolitics, supply disruptions, and persistently high inflation. As a result, central banks were largely focused on the pace and extent of rate tightening to ensure inflationary expectations remain anchored even at the expense of growth. So, where are we with regard to global growth? Despite the fastest and steepest pace of monetary tightening in recent history, the US economy has displayed a remarkable level of resilience. Aggregate activity has held up well and labor market remains strong. In the Eurozone, recovery appears to be gathering steam, and Japan as well is beginning to feel upbeat of its economic prospects. China has only just begun easing lockdowns and is expected to grow by 5% in 2023. While it is encouraging that last year's inflation surge and tightening financial conditions have not yet broken the back of growth, the latest inflation readings remain far too hot to support a Goldilocks soft landing scenario. Markets and central banks have hence begun reassessing their terminal rate expectations. Powell, in his recent testimony, acknowledged this possibility in no uncertain terms. In India too, the story is not too different. Strong credit growth, resilient financial markets, and the government's continued thrust on infrastructure spending and capex create a congenial environment for investments. The Reserve Bank of India projects FY24 real GDP growth at 6.4%. On the other hand, the higher than expected CPI reading of 6.5% for January highlights the challenges policymakers face in bringing inflation back to the medium-term target of 4%. Sticky core inflation and upside risk to RBI's Q4 FY23 inflation projections would make the upcoming April MPC meeting a live one for a hike. We expect the yield curve to continue trading flat this month and 10-year G-Sec to be range-bound between 730 and 7.5 as we head into the new financial year. While we expect the cumulative impact of rate hikes to begin weighing on growth by the second half of the year, in the near term, we expect rates to remain volatile as market wades through the push and pull of current data and future expectations. Thank you.